Hello everyone, hope you're doing well. This week we're going to start with Chapter 9, Cost of Capital. I'm going to go fairly quick because I want to get through quite a few of these slides for you. So let's talk about what we're going to talk about. Cost of capital components, debt, preferred stock, common equity. We're going to do a little bit on the weighted average cost of capital, some of the factors that affect that, and some of the adjusting for risk. We have two types of long-term capital that firms use, long-term debt. Then they also use preferred stock and common equity. Right. Capital components, they are sources of income that come from investors. Accounts payable, accruals, deferred taxes, those are not included when we talk about cost of capital. We do adjust for these items when we're calculating cash flows, but not when calculating cost of capital. It's an easy one to remember. You have before tax and after tax implications. Tax associated with financing can be incorporated in cash flow or in the cost of capital. Most firms do incorporate tax effects on the cost of capital. So only the cost of debt is affected here when we're talking about tax. And when we think about the cost of capital, we're really making decisions and investments about new things. So we're only going to talk about marginal cost or cost on top of our standard that are related to this new capital that we're raising. All right, so first we're going to look at a 15-year, 12% semi-annual bond. We're going to be able to sell it for it sells for about $1,153. So what is that rate? What is that cost? And they show you how to do it on a financial calculator, but like usual, I want to show you how to do it in Excel as well. Let me pull that up real quick. You'll see some stuff that we're going to go over later, but we're going to start over here on slide 7. It's a simple calculation using the rate function. So just very simply, let me pull this out here. You can see, so number of payments is 60. The payment is 120, and then there's the present value and the future value of $1,000. That gets us to our answer, which is 10%. All right, 10.4. Come back to our PowerPoint. We've got the 10% here. Now the reason it was 60 payments versus 15 on a 15-year is we see here that it's paid at a semi-annual rate. So that's why that was doubled. For the number of payments and also for the amount that was paid. So that's why we put in our formula 30 and 120, and that'll get you to the 10. You could also do it as a 30 on 60, or excuse me, 15 years of 60, and it will get you this 5%, and then you multiply it times 2. Either way. All right, so a component cost of debt. So we do have interest is tax deductible. So in this situation, we want to take out the cost of or the taxes and see what the true cost is without the tax, which would be 6%. In this situation, the flotation costs are pretty small on the bonds, so we are just going to ignore those. Now we're going to talk about preferred stock and what are the costs associated with that. I'll jump it back up here so you can see it. Pretty simple formula. We can see that we've got the preferred stock here, the dividends of the preferred stock on the top. We got the price of the preferred stock, but we're also going to take into account the flotation cost. We want to take that out of the equation. It's significant enough to be included in preferred stock. So in this instance, the cost of issuing preferred stock is around 9%. You can also do a timeline to generate the same data if you would like. And I'll just leave that at that, but it's pretty simple. We've got the same cost up here that we've generated. Then we've also got your dividends per quarter over top of your rate per quarter. So what we're trying to find is the rate per quarter. They already gave us the cost here. So we just do the math and play it out, and we get to the 2.25. Since it's per quarter, we would take it times 4, which would give us 9%. Either way, you can do it, it's fine. So we're going to note that flotation costs for preferred stock, I've already said that, they're significant, so they're reflected, and we're going to use it in the price. And preferred dividends are not deductible, so no tax deduction or adjustment for that. So is preferred stock more or less risky to investors than debt? Yes, it's more risky. Companies are not required to pay dividends. However, on the other side, it's not a bad investment or a bad choice because firms do want to pay preferred dividends. Otherwise, they can't pay common dividends. It gets really difficult for them to raise additional funds, and preferred stockholders could gain control of the firm. So that's, yes, it's risky, a little bit more risky, but there are definitely safeguards in place to make it still a sound investment. All right, so what are the two ways that companies can raise common equity? So they can issue new shares of stock, or they can reinvest their earnings that are not paid out as dividends. A company that I used to work for, Cedar Fair, a large amusement park company, they spend a ton of money reinvesting their earnings back into their business, whether it's with new roller coasters or new attractions at their parks across the country. That would be an example of reinvesting their earnings, as to where other companies would spend the large chunk of their earnings going back out into the investor world via dividends or stock buybacks. So why is there a cost for reinvested earnings? It's simply this: it's opportunity cost. If you're reinvesting your earnings, you're not buying other stocks, you're not paying out dividends, so that's just an opportunity cost, and that's why you would say there is a cost for reinvesting your earnings. All right, so how can we figure out the cost of equity? There's three different methods. We've got CAPM, we've got the dividend growth model, and then the own bond yield plus judgmental risk. That'll be the last one. It looks like the hardest one, but it's pretty much the easiest one. But we'll get through these. All right, so the CAPM, cost of equity. We can see we're looking at the risk-free rate plus the premium rate times the beta. So we talked about the beta in previous chapters. And a lot of times for existing companies or publicly traded companies, that number is available. But we'll talk about when that's not the case. So in this instance, we're looking at 12.8% is the cost of equity. Some of the issues using this: most analysts use the rate on a long-term, so 10 to 20-year government bond as the risk-free rate. So that, sometimes could be considered not the most accurate thing to use. Most analysts also use a 3.5 to 6% for the market premium risk. So it's somewhat of a standard, give or take 3%, right? There's a lot of wiggle room in there. It's a bit of a risk. And then estimating a beta, it's really not easy when you don't have an actual beta that has been vetted out. There's noisy, there's a lot of estimates in there, wide confidence intervals. So a lot of estimating going on here. When you look at the dividend growth model, it's a little bit different. So the main thing that's estimated in a dividend growth model is that growth rate that we see of 5.8%. And I'm not going to go through each one of these. You guys can plug in what each one of these factors are and do the math. It's pretty simple, but it gets you a 12.4% cost on the dividend growth model. So when we talk about that growth rate, you can use historical growth rate if you think the future will be like the past. Some companies are steady Eddie. They've been going for a long time. Example might be Coca-Cola or Walmart, where they're year after year after year, and they have the same growth rates on their dividends. That would be one you could be pretty confident using that model. Then you have other, you have analyst estimates that you can go out and use, and the internet gives us a ton of good information using trusted sources and different analysts across the country. You can also use the earnings retention model, which we'll show really quickly. So if we see that the company has been earning 15% on their equity, and they've been paying out about 16% of their earnings. So in other words, they've been paying out to their shareholders 62% of their earnings, right? But they've also been spending back into their business at 38%. So that tells us what percentage is coming in and what percentage is coming out. So real easily we can use this model to get to that growth rate. Now it's 5.7, so it's very close to that 5.8. So we can be confident that using different models to sort of fact check each other is never a bad thing. Now we've got the judgmental risk premium method. This is probably my least favorite, but it gives you a ballpark estimate if you feel very confident in your knowledge of the market. But you've got the rate, And then you've got, hey, this is what I think that the risk premium will be on top of that rate. And then that gives you that ballpark number. So now let's look at them all side by side. So we've got our CAPM, our dividend growth model, and our judgment model. And we can see that they vary. But coming in and having sort of 3 different things that you can average out gives you a good middle ground and something to work from. So this will be a good example of what the final result would be when you're looking at the cost of capital. Now we want to determine the weights of our cost of capital. The percentages that the firm will be financed by each component. It's possible to always use the target weights for the percentages. You can do that. So if you don't know the target, you can use estimates using the current market values and current book values. If you don't know these, then it's usually reasonable to use the book values of debt. All right, so remember that if you don't have the weights or you don't have the targets, then you use the book value of the debt. So in this example, we're going to take the stock market price of $50, 3 million shares. They have $25 million of preferred stock and $75 million of debt out there. So how do we figure out the value of the company? We take their stock times their shares. That's their common stock. We know the value of their preferred stock is $25 million, and the value of their debt or bonds would be an example there is going to be $75 million. So the total company is worth $250 million. So we're just real simply going to weight each one of these, right? So 60% of their value is in common stock, 10% in preferred, and 30% in debt. Pretty simple math, pretty simple process to get to the weights. When we want to do the weighted average cost of capital, we just simply apply this formula. Once you've done what we did on the last 2 slides, which was pretty simple, and got to those weights, it's pretty easy to plug in the different variables that you guys can see, and I think you'll find it fairly easy to understand. And once you do the math, you're going to get 10.38 or rounding up to about 10.4. All right? So that's your weighted average cost of capital. There's some factors that are going to influence this. There are uncontrollable factors out there, the market conditions, the market risk, tax rates. And then there are controllable factors that a company can change year over year if they don't like the weighted cost of capital. They can change their structure from a capital perspective, their dividend policy, and their investment policies. So is the firm's weighted average cost of capital correct for each of their divisions? So if you take the overall company's weighted average cost, so for Clorox, for example, would the total company weighted average cost of capital be correct just for their bleach division? Even though they have 10 other divisions, let's say, with multiple different, no, it would not be. All right, so you need to then, if you want to get to a division weighted average cost of capital, you have to adjust for that. We're going to talk a little bit about how to do that. So you want to estimate the cost of capital, what it would be for that division as a standalone firm. And I'm not going to really go too deep on this. The main thing you have to do is change the beta. You have to change the beta for that division, and it gets a little bit difficult, so we'll talk about how to do that. All right. So you can find several traded companies that are exclusive in this business, in that project. So, or said another way, you could find companies that are specific to that division of your company and use their beta. You can use average of their betas as a proxy, but again, it's not very easy to find that. Another way is you can run a regression model between the return on assets and the S&P index return on assets for that project. All right, so again, that's a little bit difficult to do. But it's something, if you can't find companies that are similar to your project, that would be one way to go. All right, but again, once you find the beta to your division, then you just plug that beta into the models that we used earlier in this chapter, and it's going to give you the division numbers as well. So we can see here in this example, the division's weighted average cost of capital is 14.9 versus the company of 10.4. All right. So the projects within that division would be acceptable if their returns, are above that 14.9%. It wouldn't necessarily be compared to the company's 10.4. All right. So we've also have 3 types of risk for each project. We got a standalone, a corporate, and a market risk. And the slides at the end talk about that. So I won't dig into that. I think you guys can figure that out.